Welcome to our 272nd weekly webcast. Now, we have a very special guest this week, who is my friend, Professor Ilya Strebulaev. Now, Ilya is an award-winning professor at Stanford University's Graduate School of Business. So what I'm going to do is I'm going to interview Ilya, and then after the interview, Ilya will take your questions about venture capital and fundraising. So please keep typing your questions. Now, Ilya has been researching all things venture capital since he came to Stanford 20 years ago. He's also the author of the most popular and oversubscribed Stanford MBA program venture capital course. And Ilya is about to release a must-read book called The Venture Mindset. And The Venture Mindset has received numerous accolades from the who's who in business and tech, including Eric Schmidt, who is the former CEO of Google, the founders of Zoom, Yahoo, and many others. So what I'm going to be doing is I'm going to be asking Ilya questions about the life cycle and process of venture capital and why we all should acquire the venture mindset and other venture capital questions. Then after the interview, I'm going to tell you how to attend a free venture capital webinar hosted by Ilya and how to access his unicorn report and much more. Now, Ilya is an incredible inspiration to me, and he's one of the reasons that I teach, as I've been on venture capital panels in his classes and I've mentored his students. And so it is my great honor and privilege to interview Ilya. Ilya, thank you so much. I'm so humbled that you're joining us today.
Chris, thank you so much for having me. It's a great pleasure to be here with you.
Excellent. Thank you. Thank you. Great. Also, thank you for giving me an advanced copy of your book. Now, in preparation for this interview, what I did was I created images, as you can all see here, of the 9 principles of the venture mindset, as mentioned in your book. And I think this is an awesome educational framework we can use for entrepreneurs to thoroughly understand the whole life cycle of an idea, from inception of the business model in principle, or step number 1 there, to venture capital source, how they source deals in step 2. And then in the final step, which is step 9, the exit, hopefully meaning an IPO. So if it's okay with you, I'd love to ask you questions about all 9 steps.
Of course.
Great. Thank you. Okay, cool. So first of all, when it comes to a business model, when an entrepreneur has an idea for a product or a service, how do they know if it's going to be a home run?
That is a great question, Chris. So first of all, what is a home run? A home run is when you, either as an investor or entrepreneur, invest and or devote resources, and you'll get at least 100x, as we say, which means for dollar of your money or for minute of your investments, you'll get 100x return, 100 times return. So how do you know whether it's home run? First, you never know initially. So you make bets, but you make very smart bets if you're a smart founder or if you're a smart venture capitalist. And this one you do by following the venture mindset principles. Okay? So that's what you really should realize. The reality is that you don't know in advance whether it's a home run. You believe it's a home run, and then you make smart bets by following these principles. And one of these principles, for example, to think about whether it's a home run or not, you bet on the jockey. So venture capitalists, Chris, think about that the most important thing is the team, the founding team. And so they really deep dive, trying to understand whether it is the team that can execute. You know, I just met yesterday a famous venture capitalist who told me, ideas, Ilya, he told me, are overrated. It's all about the founder who can execute on those ideas.
Makes sense. Makes sense. Yeah. I think it was Mark Cuban who said ideas are commodities, but execution is not. Okay, great. So you mentioned in principle number 1 here that strikeouts don't matter, but many people unfortunately view failure as shameful. And Steve Jobs used to say, embrace every failure, own it, learn from it, and then think differently. And so what advice do you have on why we need to fail more often, and how do we deal with that?
Yeah. So first, failure is amazing enough, is a great thing. Do you know that I showed in my Stanford research that founders who failed in their first startup are more likely to succeed in their next startup compared to those founders that did not fail. So they learn from failure. Okay, failure is a great lesson. So what's really more important is that we should strive to fail sometimes. I think the biggest challenge we have, not just as investors, but really as employees, as founders, as entrepreneurs, we're trying to run away from potential failure. As opposed to this, we have to embrace failure. And I think the way to embrace failure or to run towards it is to acknowledge that, you know what, this week, let's fail on something. Now, if you fail on something big, Chris, that's not just disappointing or sad, it's very difficult to do psychologically. Yeah. So I'm going to say something maybe counterintuitive to our audience. Try to start small projects, knowing that some of them will fail. Try to fail some of them. Let me give you my own example. Before I developed myself venture mindset principles, again, before I discovered them, my single biggest challenge as a professor at Stanford was I was studying a lot of projects, research projects. I was excited about them. And then many of them were going absolutely nowhere, Chris. Absolutely nowhere. But I had this mentality is that, you know what, smart researchers don't fail. Like, how can I fail if I'm a professor at Stanford? And as a result of that, I wasted a lot of resources, a lot of brain power, a lot of time, a lot of my PhD students' efforts on projects that were going nowhere. Now, I think it's much easier for me because not only I know that some projects absolutely have to fail if you would like to catch a home run, but you need to consciously fail some projects. And so once a month, I actually sit down, okay, and think about, here's the list of my projects. And I need to kill my darlings. And I do kill some of them. It's tough. But it's made easier by first, I know that by doing so, some other projects will become more successful. Second, I do this when they're still small. That's very, very important. So try failure. Experiment with failure. This is what successful investors do every time. Let me finish by another piece of my research. Successful venture capital investors, are more ruthless. More of their portfolio companies that they invested in fail. More. And yet, they're more successful. Because they have more money, more time, more resources to put on their successful companies.
Interesting. And Michael Jordan said, I failed over and over again in my career, and that's why I succeed. It's great advice. Okay, cool. All right, let's move on to principle or step number 2, which is deal sourcing. Now, you mentioned to get outside the 4 walls and build a diverse network. What would you say is the best way for an entrepreneur or a venture capitalist to build their network?
Yeah. So first of all is that, one of my insights, one of the unusual discoveries was that when I studied how venture capitalists ended up making these investments, I found out that they came from so many different sources. From their professional networks, from self-generation, from cold calls, etc. And so the principle that I call getting outside the 4 walls. Indeed, you know what? You typically meet venture capitalists in their offices only once a week when they have their partner meetings on Monday. The rest of the week, they travel, they meet with founders in various situations. So it's not just about the size of your network. That is what I discovered about VCs. It's about meaningful diversification of their network. So the very first thing that I think if you're a venture capitalist, if you're an emerging venture capitalist, or if you're a founder, or if you really would like to expand, get outside your 4 walls. My first advice is if you have LinkedIn profile, and I know, Chris, you have a wonderful LinkedIn profile, go and check your LinkedIn profile. Not just the size of it, okay? But how diverse it is. So I worked with one of a large company, and I found that corporate entrepreneurs, okay, they're not diversified. And so So I worked with this company, and the CEO said, well, let's check right now. So it happened was that most of their LinkedIn connections were either their peers, so those that their colleagues, corporate colleagues, or their university friends. So try meaningfully to diversify. How to diversify meaningfully? Think about unusual situations where you can meet people that are potentially interested in you, but you don't do it. So I started talking to people about my research, about my teaching, in situations where I typically don't do it. So after I realized this, I do many more events like this, but also live events, where I talk to people and I exchange information. And yes, like we talked about failure, many of these contacts, don't lead to anything, but some do. Let me give you an example, a story. Another one is, I'm not sure about you, Chris, but I travel all the time. So how professors travel, Chris? Well, I used to travel incognito, meaning that I would have a book or a research project on my laptop open, and I never talk to anyone, ever. On the plane, no. So nowadays, I purposefully say, I travel on the plane typically, okay? There are actually a lot of interesting people travel on the plane. They're outside my network. And so I now have a goal of talking to at least 4 people, meaningfully, whom I don't know when I travel on the plane. So just a couple of weeks ago, I was flying from New York Airport, and I met this person whom I would have never ever approached in my prior life before I myself uncovered those venture mindset principles. And I started talking to him. Turns out that he's a journalist. He's covering horse races. He's actually a very famous journalist, turns out. He just came from Dubai, from the World Cup, horse racing. And we started talking about, horse races, jockeys versus horse, and the venture capital, jockeys versus horse, founders versus the business model. And he ended up writing an article about this in horse race publication.
Nice.
So that is the tangible result of getting outside the 4 walls. So advice for everybody: think about how to get outside the 4 walls, what you do typically to enlarge your network and build meaningful connections. Everybody can do it.
I love it. That's fantastic advice. Speaking of LinkedIn, you're a top voice on LinkedIn, which is very hard to get. What advice do you have for my students and participants on this call on how they can leverage LinkedIn as a journalist, so to speak, in order to be a top voice in a given category?
Please, first, I think given category is critical. You have to choose your niche. All of us are experts in something. Okay? And I think you have to prepare your mind. That's another principle. Prepare your mind. And when you prepare your mind, you can become a niche in something. So be authentic and prepare your mind. And then, it takes a lot of effort. But I'm trying to ask myself a question, which is how what I do is really useful and helpful for my followers or for my potential followers. So you mentioned at the very beginning the unicorn report. And so I study all the unicorns and what are the factors that make it possible for small startups become this very successful large companies. And my audience, I think, is very interested in this. And so before I started doing this LinkedIn thing, I never asked this question because I was doing this from the academic point of view. But I think the audience wants practical applications. And so by asking a different question and by talking to your audience helped me. How did I find this out? So before, in fact, I got top voice on LinkedIn, I had around maybe 12,000 followers. And so I went getting outside the 4 walls, Chris. I selected random 10 followers. whom I don't know, not my former students, not my colleagues, not venture capitalists whom I know 10 followers, whom I never met before. They just followed me, and I contacted them. And I asked them, would you mind spending 15 minutes? Everybody said yes. And I asked them a couple of questions, and one of the questions I asked, so why do you follow me? What do you want to get out of it? Okay? And I liked it so much, I actually contacted 85 more. So in total, I contacted 100 followers. And I learned a lot from them. And so my suggestion, Chris, again, is trying to, in business, it's actually has nothing to do with LinkedIn. In business, try to talk to your potential customers.
Smart.
Current customers, potential customers, what do you need from you, how they can benefit from you or whatever you do, your service, your product, and then try to use this information. So I think the mistake that many people make, I use myself to make a lot, is I'm making judgments for other people. I think, oh, Chris follows me because he likes this. No, when I ask Chris, it turns out to be that's not the case. So I nowadays try to make less judgments about people. I try to find out more information first.
I love it. That's great advice. Ramon from Saskatoon said great advice as well here. Okay, next question is, your research suggests that college dropouts are more likely to achieve unicorn status than non-dropouts. Why is that the case?
Yeah, so first of all, just I don't recommend anybody to drop out. Okay, if you just drop out, there's no causality here.
Yeah.
If you just drop out, it doesn't mean that you will achieve unicorn founder status. Okay. So I think in the cases the following is that, and I met some of them at Stanford who, they had to drop out. I think that is the combination of the following. You come to college, you get an entrepreneurial idea that is you're absolutely passionate about, you prepared your mind about it, and you just cannot wait to graduate, to proceed with this. You start this, and most of the time when they drop out and become unicorn founders, what happens is they actually start a company while in college. On their own, more likely with the co-founder, maybe their roommate, okay? And the company takes life of its own, and they face this trade-off, and they choose the company. The company takes all their time. So I think the real question that for the audience, for those in the audience who are in college, is that don't drop out, okay? But the trade-off you will face is that if you already have a company and it is snowballing, it's scaling up, so then my statistics will potentially help you, is that college dropouts, when they already have a company that is snowballing, they have much higher chances of becoming a unicorn founder.
Okay, makes sense. Thank you. And also, based on your research, 33% of venture capital deals feature a founder and an investor who studied together at university. And so, what additional advice do you have for entrepreneurs on how to network who did not attend university?
Who did not attend university?
That did not go.
Yeah, because if you attended university, it's very simple. Try to find investors, angels, not necessarily VCs, Chris, angels invest VCs who are from the same university. So that's what my research shows. Not only you're more likely to get a deal, that deal is more likely to be successful. Now, if you did not attend a university, then I have another piece of research that shows that cold calls could be very powerful. So one of the most, I'm not very sure the way how you look at it, amazing or stupid piece of research I've done is my team and I created 30 fake startups. We created fake websites, fake LinkedIn profiles, fake founders, a lot of fake founders, okay? And we sent emails with cold calls, like blurbs about the founder, about the startup, to real VCs. You might have received that one, Chris, okay? So, and then we collected responses. And many VC friends told me, this is really stupid because we never respond to cold calls. But we wanted to check this scientifically. And do you know that the response rate was on average about like 10, 12%, between 8 and 15%. And do you know what happened? More successful venture capitalists responded with a higher probability.
Wow.
And they responded by asking specific questions. Can you send me a pitch deck? Can we meet for coffee? Can we meet for a Zoom chat, etc., etc., etc. So cold calls work. Of course, you have to think about first meaningful cold call. You have only two paragraphs in an email. Nobody's going to read long emails. I'm getting long emails all the time. I mean, you cannot read them. Two paragraphs. One paragraph is about you as the founder. Another one is about startup idea. And those two paragraphs must answer two questions. Why would you do or would like to do really meaningfully will impact people or businesses? Meaningfully meaning the market impact and market size. Second question you have to answer is, why it's you, Chris? Why it is you and nobody else who should be doing this? What is the founder to product fit? The founder to market fit? And if you answer those questions yourself, if you really believe in them yourself, put this into paragraphs, okay? Make sure that those paragraphs are copy edited, okay? And I think you'll get a pretty high response rate.
That's great. I love it. I love it. Now, in terms of getting outside of the four walls in step 2 here, why doesn't more innovation come out of very big companies?
Gosh, if I start, Chris, we're going to be here for the entire day.
Okay.
So this is like one of the biggest puzzles, really, because if you think about this, large companies, they have a lot of people, a lot of smart people. They have a lot of resources. They have more resources than startups. And yet, you know, most successes in recent years come from startups. And I studied all these large companies, and they fail all the time, fail with their innovation journeys, especially when they face disruption. And so there are a number of reasons. And in fact, the book is also about how to overcome those reasons, because the book is full of practical actions, both for founders and investors, but also for those in large corporations. But one very, very, very important reason is I called NIH. Not invented here. And so let me tell you a story. So one of my dear friends is Claudia Funmans. She's an amazing venture capitalist. So for about 25 years, she had been the head of IBM Ventures. You know IBM. Everybody knows IBM. Okay? And IBM Ventures was a venture arm of IBM investing in startups on behalf of IBM. So what was her single challenge? When I asked her, Claudia, what is the single biggest pain point you had? And she said, without even thinking, my single biggest point was, I would find this amazing startup in Silicon Valley, in the heart of what IBM is doing. Like IBM absolutely needs to look at those. She would take these founders by the hand. She would bring these founders to the IBM people. And IBM people look at Claudia and say, whom did you bring to us? Those kind of renegades, badly dressed, not in a suit like you, Chris, okay? So, and also, you know what? We have much smarter engineers. Like, we can do much better than those two guys. And the truth was that IBM could do much better. It was not on their priority list. It was not the top like 1,000, okay? And so, of course, they never did. And if you look where IBM is now, it is not. Nobody mentions IBM these days in the same rank as Microsoft or Google or Amazon or Netflix, okay? And the reason is NIH, not invented here mentality.
Interesting. Fascinating. Okay. Now, in your book, along this topic, you mentioned that Qualcomm's venture capital division has done really well investing in startups like Zoom, for example. Now, what advice do you have for large companies that want to kind of emulate Qualcomm Ventures in order to kind of supplement their own internal R&D efforts?
So that is a great question, Chris. Thank you. So we have an entire chapter in the book devoted to this, and the chapter is called provocatively, Agree to Disagree. What this really means, and this is why Qualcomm invested in Zoom. There's no this reason, okay, was that when Nagarj Kashyap, the founder of Qualcomm, and Patrick Agin and Sachin Deshpande, his colleagues, they fell in love with Zoom and Zoom founder, they went back to the Qualcomm investment committee, and everybody else, Chris, turned them down. There were no other takers. Everybody said, this is really stupidest idea you could imagine. And they had good reasons, by the way. That would have been the end of the story had Qualcomm Ventures not been designed differently, where a minority could have still have made a decision. So agree to disagree means, first, in large companies, you have to promote disagreements. You know that one of the biggest challenges in large companies, especially in corporate VC or in corporate innovation, is we're trying to find consensus. Okay? We're trying to ensure that everybody feels comfortable about the deal. When you try to catch a home run, you can't have comfort, because home run has not yet happened. It's out there, okay? So you have to promote the lack of consensus. And in fact, there are specific tactics you use that we learned from venture capitalists, and all of them are in the book. Some of them are extremely simple. For example, in any group decision, in any group discussion, junior people must speak first. The moment the boss speaks, that's the end of the story. There will be no need for consensus. It's going to be called conformity. And so there are many practical lessons. And second is, whenever you are trying to catch a home run, you need to allow minority to rule. You need to allow individual whom you trust, or just several people, to experiment on their own, even if the majority or everybody else disagrees. We actually have a special name for this in the book, which comes from this study of all places, monkeys. But I will not explain this now. It's called leckerism, L-E-K-K-E-R-I, leckerism. So if you would like to learn about leckerism, well, I would love to promote in large corporations. You have to read the book.
Okay, great. No, thank you. I love the concept of getting more junior employees to speak first so that ideas are not suppressed. That's brilliant. That's brilliant. Brilliant. Okay, moving on to principle number 3, where you mention from an initial idea screening perspective to kind of prepare your mind and invest upfront in learning. So how do venture capitalists and entrepreneurs learn about a new technology trend that's going to be in demand in the long run?
I already mentioned the prepared mind. And I think that is what really separates smart VCs from those who just bet like gamblers. If you think that there's going to be an interesting trend, interesting new market, you just dive into this. You meet every single expert. You meet every single startup founder. And the idea behind this is that finally when you meet a startup of your dreams, you will know this more or less immediately. But this immediately, you have to prepare for this, maybe months in advance, okay? Maybe you have to put in hundreds, if not thousands of hours. And this mind preparation, I think, is really critical. And I think it's not only for venture investors, it's for everybody. It's for everybody. So let me for a second tell you about, again, my own research. Do you know, I think the difference between senior professors who really think about research and junior professors or PhD students is that I think that if you prepare your mind, and this takes a lot of effort, then when students tell me about various research projects, I immediately can identify some that I've never heard about, but they seem very interesting. So that is the power of the prepared mind. I think the same is about venture capitalists. And I have a lot of stories about this, where seemingly venture capitalists made decisions like on the fly, bump, But in reality, it's not.
Hmm.
In reality, the smartest decisions have long time to prepare.
Interesting. Okay, cool. Let's move on now to step 4, which is due diligence. Aside from analyzing the management team, what kind of qualitative and quantitative investment research do top venture capitalist firms do in order to kind of assess if they should invest or not in a startup?
So, I did mention founding team. It's of course critical.
Yeah.
They do have a lot of research on the horse aspects, and that is the part of the due diligence. And the horse meaning the business model, the market size, the product, and here are some of the questions they try to answer. First, how large is the market, or how large potential market can be? That's very important. Okay. Second is, eventually, how are you going to make money? And by the way, you can make money in different ways. So some startups will never make any money, but they will become very valuable by being sold to somebody. So venture capitalists will think, well, Chris, it's very unlikely that whatever you do is going to be profitable. But you know what? I think that Amazon definitely is going to buy it. So that's also part of this business model. But they will need to answer this question. Another question is, what is the competition? Who else is doing the same? And by the way, they're more worried about small startups than big companies. Again, big companies are slow moving. And they're more afraid of a startup that is maybe 6 months ahead or $5 million ahead of you. There are a lot of specific questions that VCs ask. Here's the critical point for those in the audience who would like to become founders or already in startups. And this is when I teach my Stanford class. And by the way, it's called venture capital class at Stanford, but in fact, more people are entrepreneurs would love to, in fact, more people who graduate from the class become founders of venture-backed companies. Here's the critical point I tell them. If you would like to raise venture-backed money from the best investors and you would like to succeed, you absolutely have to feel in the shoes of a venture capitalist. And I give my students the list of questions that VCs ask. It's like 50 questions. And you have to answer yourself every single question. And it turns out that some of the questions you don't have an answer, prepare your mind. Because VCs have this interesting ability very quickly to coalesce around the weakest points you have. Because that is where they face uncertainty. That is where they will have to make a decision, a leap forward, or they have to stop. So if you're a founder, you have to answer every single of those questions yourself, or with your co-founders.
I have to ask you, can you share a couple of those questions with us?
Well, first of all, you mentioned the webinar at the beginning. So those who attend the webinar will get the entire deck with all the questions that I share with my students because the webinar is based on my Stanford VC class.
Okay, perfect. Thanks. And for everybody on the call that just joined us, at the end of this Q&A with Ilya, I'm going to tell you exactly how to attend a free 2-hour VC webinar with Ilya. Okay. Next up, you mentioned FOMO in step 4, meaning fear of missing out. And so many entrepreneurs want to start AI companies. And I'm sure many venture capitalists are spending a lot of time looking for the next killer AI startup. But aside from AI, what other technology trends are top venture capital firms looking to invest in right now?
It's a great question. So first of all, I don't see this AI as the space. Rather, there are many AI-related spaces. So AI is everything and nothing. So I don't think that venture capitalists actually look to invest in AI. They'll rather look to invest in specific things that AI are related, okay? But here's the interesting trends. One is, I think, AI, there are a lot of enterprise AI-related ideas. And I think VCs actually look to identify teams that that are going to execute on those ideas. Ideas are pretty well known. For example, I just yesterday talked to AI VC, enterprise personal assistant, so that you have your own AI executive assistant who's going to do everything for you. This is the obvious idea. Okay, so the question is how to find somebody who's going to implement this correctly and will be able to sell it to enterprises. Okay, so there are maybe like 50 startups trying to pursue it right now, and those VCs are trying to prepare their mind and meet with every single team. Now, apart from pure AI, so to say, okay, in Silicon Valley at least, one of the most active topics these days is defense. For obvious geopolitical reasons that we're facing, there are a lot of defense specialized funds, and defense could be both software and hardware. For example, there's a lot of robotics startups, and I think there's a huge inflow of money in defense related startups. Okay. Another one is gaming. So gaming and I think the future of entertainment more broadly is a huge topic. And when I started teaching venture capital, they were gaming, but like the future of entertainment was a non-issue. Like how many sports startups you met 15 years ago? Nowadays, there's so many interesting stuff happening, and there are funds, and actually there are a lot of celebrities that invest professionally in startups. And the final topic I mentioned, which I think is very close to my heart and to you, Chris, is the future of work and the future of education. Because we are going to get educated differently in the future. And we're going to work different in the future. Our relationship with work, okay, not for founders, not for investors, for all of us, is going to be different. Now, we don't know yet how different it is, but I think there are so many interesting ideas, and I'm seeing so many interesting applications, and there are specialized VCs who are rethinking this future of work. And I think that is another huge space that is being developed right now.
I love it, and I bet my career on that. Now, speaking of AI, the CEO of NVIDIA, Jensen Huang, recently implied that we don't need to learn coding because AI is going to do that for us, and perhaps it's better to study liberal arts in university if we want to become more successful because it leads to creative thinking. And so, in your research, you mentioned that American students, unlike students in Europe and Asia, American students do not select their major until the third year of university. And so, do you think this might give the American education system an edge over the education system in other countries in the long run?
That is a great question, Chris. I do believe that American university education, college education, not the high school, but the university education, I think is right now ahead. And again, that is because American college education system, for historical reasons, is more flexible. So just to give an example of Stanford, but Stanford is not an exception, it's a pattern. A student who comes to Stanford, they don't need to choose their major or their specialization in the first year. There are so many students at Stanford who take computer science and English literature at the same time, or performance arts, okay, or history, or math. And then only by year 3 they have to choose. And so that creates two trends. One is diversification. So students are exposed to more stuff. And in the past, actually, it was less helpful because the life was predictable. And so you become an engineer, you spend a lot of time on becoming an engineer, and then you spend 50 years being an engineer. And these days, the life is much more unpredictable. I kind of agree with Jensen Huang.
Okay.
You have to, because the whole point about learning is not to learn things, but to learn how to learn. And for this, you need to be much more flexible. And I think that I use Europe as an example. I think many European universities that were created back in the 19th century or 18th century, they are much less flexible. You actually don't become a student, let's say at the University of Heidelberg. You become a student in a specific department. I can tell you, I'm originally from Russia, and I studied in Russia originally, and so my bachelor degree is from Moscow State University, considered to be the best university in Russia at the time when I studied. But I was not really a student of Moscow State University. I was a student of the economics faculty. And if after the first year I thought, oh gosh, I hate economics, I would love to be like, move to physics. Bad luck. That's that. So I think that is the biggest advantage we have in the American education system. But there is always trade-offs in life. It also creates a challenge. A challenge is, do you know, Chris, I've seen many students who came to Stanford. It's difficult to get to Stanford, okay? They're very smart. And they're lost. And they're lost because there's a lot of flexibility, but at some point you have to commit. And they never commit. And they spend 4 years at Stanford, and at the end of the day, they have not learned much. That also may happen. So there's no one optimal solution, but I still believe in the American university education.
Cool. Thank you. Awesome. All right, let's move on to step 5 or principle 5. Now, I completely agree that we need to focus on the entrepreneur first, meaning the jockey, and a bit less so on the horse. And what are the most important characteristics in an entrepreneur that venture capitalists love to see?
So that is a tough question because I talked to so many hundreds of VCs, and they of course had their own kind of tricks, and we try to distill them in the book. But couple of points, actually 3 points. One, charisma. Now, charisma is difficult to define, but I think when you see a charismatic person, you can see it. You can see this. One way that charisma is revealed for VCs is the ability to make people follow you. It's very easy for Jason Huang now to make people follow him, okay? He's a billionaire, etc. But if you're nobody, no money, not famous, it's very difficult. And so that's one. 2, passion. You absolutely have to be passionate about what you do, about the pain point that you found and you would like to solve. And the third is resilience. The life of a startup founder is extremely tough. Every single successful startup was on the verge of disappearance, bankruptcy, wipeout so many times. You have to be resilient. And I think VCs try very hard, try to identify those founders who have some charisma, have passion, and resilient.
Interesting. And Manas from India just wrote, Professor Ilya is charismatic, hands down, and I agree. Next question I got for you is, if a student of mine gets into an elevator with a top venture capitalist from Sequoia, for example, what should they say in their 30-second elevator pitch?
First of all, what is the goal? The strategy of the 30-second elevator pitch is not for VC to invest in them. It's for VC to say, I would like to meet this person again for coffee for half an hour. So that is the goal, okay? So they absolutely must say something that will surprise that venture capitalist. Let me tell you something that I think resonates with me really deeply. Venture capitalists love when they learn from founders. Which is, if I'm a venture capitalist and Chris, you're with me in an elevator, and you start talking about your startup, and in 30 seconds you say something that I actually do not know. Maybe a fact, maybe a story, maybe something that I do not know. I said, I actually would like to learn more about this. And so you have to think. Again, you need to know your space very well, okay? To think about one fact and one story that will really resonate. So I think that is something that is critical. I met recently with a former student of mine who is a well-known healthcare VC, and he is meeting with a lot of founders. And so he went to this healthcare event, 3-day event, where he met like hundreds of founders, or hundreds of startups. And so he was walking around the room, and he had maybe more than 30 seconds, but 3 minutes, okay, per founder spiel. And And he said, I immediately knew whom I would like to see again. Because they were telling me stuff that even though I'm a healthcare expert in this space, I actually do not know exactly. Or they were telling me stuff that I thought I was the only one who knew. So that is I think is it's not easy, but I think that is what every single founder should work for.
I love that. Love that. Thank you. And later on today, I'm going to tell all of you how to get Ilya's 200-page unicorn report. Now, I saw in your unicorn report, you mentioned and analyzed more than 1,200 companies in the United States that are venture-backed unicorns. What are the top 3 qualities or more qualities that we haven't discussed yet that unicorn founders have?
So, we discussed charisma, passion, resilience. Mm-hmm. And I think unicorn founders have at least some of those. Okay, that's one. Mm-hmm. 2 is that they have qualities which are difficult to change. Or if our audience is still in college or trying to get to college, you can change it. So if you pursue specific majors in college, you're more likely to become a unicorn founder. And by the way, it's not necessarily computer science, Chris. Do you know that we found computer science up there? Okay, fine. But do you know which one we found that has actually pretty high chance? Performance arts. And that's going back to Jensen Huang's and creativity. Yes. Okay. So the major what you do in college, I think, matters. Of course, which college you go to matters. It doesn't need to be Stanford, by the way. There are some colleges that are really ahead of the game. Do you know the college in the United States that has the highest single, what I call odds ratio scientifically, which means the highest propensity to become a unicorn founder if you graduate from it and become a venture-backed entrepreneur? University of Cincinnati.
No kidding. Wow.
And I published this on LinkedIn, and the first message was from, I think, the chancellor of the University of Cincinnati. He thought that I had some connection to Cincinnati. I don't. That's what my data showed. Okay, I let the data speak. There's another feature which is really interesting, and again, it's not that you or I or anybody of our audience can change it, but that's the fact. Immigrants have a much higher chance to become unicorn founders. Do you know this is one of my favorite statistics and one of the shocking statistics of my unicorn research? If you look at the entire sample of all unicorn founders in the United States, those are American companies, Chris. American companies. At least 44% are immigrants. At least. Almost every second.
Amazing.
Is an immigrant.
It's fascinating. Fascinating. Now, let's move on to step 6 of 9 here. So in principle 6, you mentioned decision-making when it comes to venture capital investments. How do you create a culture of encouraging disagreements? How do you create a culture of encouraging disagreements without the risk of junior employees upsetting the political structure of a company?
Yeah. I already mentioned that juniors speak first. But let me step back. You impose rules. When you impose rules from above, okay, that means that you upset the rules yourself. So the first rule is juniors speak first. Very simple rule to implement, okay? By the way, it turns out to be, it's much easier to implement in Japanese companies than in American companies. Why? Because in Japanese companies, everybody knows their rank. Okay, you can just speak by rank. Another interesting rule is you provide your feedback anonymously. For example, we talked about investments, but let me talk about something else. So let's say there's a hiring process. You hire somebody, and maybe there's a committee of, let's say, 5-7 people. So what is the typical interview process? Well, there are 7 of us, Chris, and you enter into the room and we interview you, or maybe on the Zoom chat, and we interview you. And then once you leave, okay, and we thank you, we immediately start discussing what we think about this candidate. That is perhaps the single most counterproductive thing to do in the interview process. What you really have to do is before you start discussing, you must provide your feedback without being biased by everybody else. Ideally, this feedback is completely anonymous. So that I don't know who provided this, the senior person or the junior person. And only after every single person provides this feedback, you can reveal and then discuss. Again, it's a very simple rule, Chris, to implement. Now, it should be implemented, of course, by the upper ups, higher ups, but it's relatively simple to implement. That is my recommendation. Whenever I work, and I work a lot with the leaders of global companies, I always provide this sort of simple tactics that are easy to implement, and they immediately have a huge impact.
I love it. Junior, speak first. Now, I find that the best hedge fund investors are often not in New York City because they're not subject to groupthink when it comes to hanging out with other friends in New York City that work at hedge funds. Now, I know that there's a lot of venture capital firms here in the Bay Area, and the top firms see all the same deals and they hang out together. How do they avoid falling into the groupthink trap?
Yeah, that's a good question, because some of them do. Some of them do fall into this trap. So, first is that, once again, they actively encourage dissent. And let me provide just one example of this, or one of the rules they implement. And this rule has a beautiful name, devil's advocate. So let's say there are 7 of us, Chris, okay? And you and I together have to make some decisions. Let's say consider some startup. And if I'm the deal champion, so, I bid on the table and I say, we absolutely all must invest in this startup. One of us, maybe you, Chris, is appointed as a devil's advocate. And what the role of the devil's advocate is to try to find reasons why we should not proceed with the investment. And of course, you just don't say, oh, I don't like this deal. That's not serious. You have to go through and do your homework, do your due diligence to identify all the weak spots. Notice, you mentioned political structure. First, by appointing devil's advocates, we remove stigma. That will say, oh, Chris is a negative guy, he always doesn't like anything, okay? So we say, no, Chris is appointed to be devil's advocate. Second, is that our goal here is to surface all the problems. Because if I am passionately in favor of the deal, I kind of might, not discuss the weak spots. Because my goal is to sell the project to everybody. So we need to find the balance. And I think most smart VCs do proceed with this devil's advocate or similar structures. So that is an example. And I think, again, it has nothing to do with VC. If you're in a large organization, or even if you're in a student group, experiment. Try the same.
I love it. That's great. Okay, now in terms of step 7 here in your book, when it comes to subsequent investment rounds for venture capital firms like the B or C round, how does a venture capital firm decide whether to invest more money in a company given their pro rata rights or not to invest additional capital?
That is a great question, because this is also one of the dangers of the venture capitalist. The danger is you fell in love with the founder, you invest, and then it is not going well. And you have the tendency to, as we say, throw good money after bad. In fact, psychologists have a name for it. It's called escalation of commitment. So VCs know, and they use many, many methods to avoid this, at least smart of them. So one is, let me give you just one example of the method. They try to use the audience, so to say, okay? They try to invest only if they can find another reputable venture capital firm that is new to the startup, that is going to invest as well. So that basically we say, look, we already invested, we're biased, we need to find somebody else. If we cannot find somebody else, something must be wrong with us,
right,
with our thinking. And I think this is, by the way, why the reasons why many venture-minded organizations are doing the same. Think about this: Google, Alphabet, Unit, Waymo is self-driving cars of Google. Everybody heard about it. Do you know that they invited some VCs to invest in Waymo? Why? I mean, Google is awash with cash. Why? I think one of the reasons is escalation of commitment. They want to ensure that somebody else will come in and value this intrapreneurial startup inside Alphabet correctly.
Fascinating. Now, a lot of entrepreneurs really get worried about getting diluted when they raise money, and they worry about giving up control to a board that might want to replace them. And so, what advice would you give to entrepreneurs when it comes to what VC firms and board members they should select?
Yeah, that's a critical point, Chris, because you know what? Startups last a long time. And if you make a mistake in selecting a venture capitalist that is going to become your board member, first, you just increase the chance of your startup being unsuccessful at the end of the day, but also you dramatically increase the chance of being miserable for the next 10 years. So selecting the right board member, I think, is truly critical, okay? As I tell my students also, you can lose control only once in a startup. Many founders make a mistake, I believe, of caring about valuation more than about control. In fact, I have some research confirmation of that. So that if they face two venture capitalists and one venture capitalist offers them a better deal, which is basically more money at a high valuation, they will take it, even though that means that they will lose more control. And more often than not, it's a bad idea. It's a bad idea. So you should give venture capitalists some degree of control, because otherwise smart VCs will just not invest. But you should try to delay the moment where VCs can just kick you out. So I think that is the lesson from, by the way, for both the founders and investors.
Smart. Yeah. A bad investor is worse than a bad marriage. Yeah. Okay. So in terms of step 8 or principle 8, what I love about startups is there's a near unlimited amount of money that entrepreneurs and VCs can make. And so what advice would you give entrepreneurs when it comes to giving stock options as kind of golden handcuffs? And are there any traps that entrepreneurs and investors should avoid, like getting common shares versus preferred shares?
So, well, there are a lot of traps. Let me start with the generic point. If you would like to retain somebody, if you're a founder and you would like to get great employees, make sure that you do give them long-term incentives. Salary doesn't help. People just will leave, okay, and go somewhere else. Do give them stock options. Do give them stock options that vest over time. And ideally, it's longer. And you know what? Don't be afraid too much about dilution. Be prepared. Be prepared to share. Make the pie bigger, as I say. Traps. I think the single biggest trap, Chris, that I observed is between the co-founders. Because if you and I co-found a company, we kind of know that we hire somebody else, we need to give them long-term vesting. But you and I are founders, Chris. Like, you own 50%, I own 50%. And very often what happens with the co-founders is that they vest right away. And what happens then? 6 months later, I will tell you, Chris, you know what? I no longer want to work with you. Or I found something else. Or, Apple wants to hire me. And I leave. But my options are already vested. That typically is a death threat for a startup.
Makes sense.
No VC will invest if a founder leaves with a non-trivial ownership stake. So the single biggest trap to avoid is make sure that the co-founders, including you, also have the same vesting.
Makes sense. Thank you. Great. And the last step here is the exit, step 9. I find that many successful entrepreneurs don't want to have an exit. You know, they don't want to sell their company for a few $1 million or even a few $100 billion because they want to put their dent in the universe, so to say. So when you say avoid short-termism and instead embrace long-term, what is long-term? Is it 20 years? And is it a trap when an entrepreneur is asked what is their exit strategy if they're too short-term focused?
It's a good question, Chris. So I don't think of long-term in terms of years. It's not 20 years, it's not 10 years, it's not 1 year. I can provide the statistics, but that's not the point of here. The point here is your attitude. So long-term is really when, long-term thinking is when you work on a company not in order to sell it right away. By the way, you might need to sell it very soon, okay? But long-term thing is you're going to develop this company into a hugely successful, large enterprise, no matter what. Maybe it will take 20 years. And then, you know what, a year later, you get an acquisition offer and you'll sell it. But if your intention from the very beginning is, oh, you know what, we should work on making sure that a year down the road we will get an acquisition offer and we'll sell it. That is short-term thinking. So short-term versus long-term is not about years, it's about your intentions. And short-term thinking typically does not work well in venture. Either if you're a founder or if you're an investor, and it doesn't work in a large company as well.
Yeah, as Warren Buffett said, the longer the view, the wiser the intention. Now, a lot of private companies I've analyzed when I worked at VC, I saw quite often revenue growth is accelerating. But when I look at publicly traded companies, I see most companies have decelerating revenue growth unless they make a big acquisition. Now, is the time to go public for a private company the moment that revenue growth is decelerating, or are there other factors that kind of dictate when a company should go public?
That's a great question, Chris. I think the time to go public depends a lot on where the market is, and also depend a lot where you want to take your company. Sometimes it is about growth because you believe that you would like to get more capital to support, to back your future growth. I think the danger for the public market investors as well is that some would like to take their company public where they no longer believe in the company. They say, okay, there's a great company, guys, we're no longer going to grow, let's just sell it. That's a bad idea.
Okay, makes sense. Thank you. Okay, great. So Ilya, thank you so much for answering my questions. Now, before Ilya takes all your questions, which I'll read in a moment, everybody in the webcast, please check out Ilya's book, The Venture Mindset, which can be accessed from the description of this webcast. Now, there's two links. There are two links in the description of the webcast. The first link is a link to the book on Amazon. And the second link is how to attend a free VC webinar hosted by Ilya and how to access his unicorn report and much more. Okay, so what I'm going to do now is I'm going to go to the audience to take some questions here. While I'm looking through questions, I'm going to ask you one question I ask all the people I interview, which is, if you could go back in time, what advice would you have given yourself before you started your career as a Stanford professor?
Well, when I uncovered all these venture mindset principles, now many of them seem so obvious to me, but I had no clue about them when I started my career. Indeed, when I was a student. So, Chris, advice that I would have given myself is if I could have a glimpse of those venture mindset principles and how could I implement them into my personal life, my professional life back then, I definitely would have taken on board. Like, I would have changed so many things I've done, but I had no clue. And again, they're not like, you don't need to become Isaac Newton to understand all those. They're relatively straightforward now, but they were not back then at all. I have no clue.
Very cool. Thank you for that. Question from Robin, which is, do venture capitalists care about cybersecurity of the product at this point?
They do, especially in hardware robotics. They do greatly. And they do greatly because in the world of AI, cybersecurity takes on a new dimension, which is, a lot of good people can do many things with AI, but so a lot of bad people. So it's a game of cat and mouse. There are many more venture capital firms that specialize or even raise special funds just for cybersecurity.
Okay, that's great. A question from Vishnu, who says, hi, Ilya. Aside from AI and defense, are there any other trends currently in the VC circle in the United States that investors are paying attention to?
Well, so I mentioned future of education, future of work. Let me mention another one, but I think I should have mentioned earlier, is climate tech. There is maybe at least 20 funds I know that were raised in the past 12 months. Many of them are in hundreds of millions of dollars, billions of dollars, that are devoted to finding the various disruptive climate solutions.
Interesting. Okay, great. Next question is from Photos, who wrote, how widespread is access to venture capital for Latin American companies? Because in general, it is seen that there is a requirement to start activities in the United States.
Latin American could be Latin American in Latin America, or Latin Americans who come to the US. So that's why I will answer like two sub questions, Chris. First, you know what? I've just given an amazing session to entrepreneurs in the US who are from the Latin community in the US, from the Hispanic community in the US. And so find out about this community if you're in the US, which is, I think it's called LBAN. Latin Business Association, I guess, or American Network. And in fact, a number of my students started an organization called La Familia, which is an organization that gets together Hispanic founders and investors in the US. Now, if you are from, in fact, Latin America, okay, then do you know that there's a boom of venture capital in Latin America? In fact, especially the early stage, pre-seed, seed, Series A stage. In fact, I have like at least a dozen students of mine who within the last 3 to 4 years went there and set up early stage VC funds. So I think right now, it's either booming or about to boom. Do your homework. Follow all this venture minds principles. I think that is the right time to start companies in Latin America.
I love it. And Photos, if you want, you can send me a message about that group La Familia, and I'll get the details from Ilya if you'd like.
Absolutely.
Next question I've got is, thank you for this incredible session in your book. I'm looking at starting a company to educate women in leadership in AI. I think this space is saturated. Anything I can do differently?
Again, let me mention another organization that my students started. It's called Galvanizer. And Galvanizer is the organization that tries to help women founders. I don't think that they concentrate on AI, but again, Chris, I'll be happy to send you the information. But my recommendation is check them out, maybe contact them, because I think that we need to do much more. My econ statistics is pretty sad when it comes to gender. And in fact, the trend has not been very positive in the last 10 years. And I think that we do need to make changes. So I really love the organizations like Galvanize. I'm sure there are others, just that I know Galvanize because it's started by my own students. And I think when it comes to AI, we need to do even more.
Yeah, I agree. And one of my students, Brenda, started an organization called Providing Opportunity for Women, POW. And she, based on her research, she found there's more CEOs in the United States named John than there are women CEOs. Yeah, it's tragic.
That's pretty damning.
Yeah. Okay. All right. Next up, Ramon from Saskatoon's got a great question. Is it possible that the new FTC rule banning non-competes will impact negotiations between founders and venture capitalists?
A great question, Ramon. So I think in California, likely not, because in California, really non-competes already were diluted a lot.
Yeah.
But in many other states, I think that this will have a non-trivial impact. For example, let's say in Texas, there's actually research from my friend Professor Conte, I believe, who showed these differences, which is his team went and collected the non-compete rules in every single state and showed how this affects startup activity. So I think that especially in those states where non-compete rules were enforced, the new FTC rules will have an impact. Of course, if they go through, because I'm sure you've heard about that, there are lawsuits coming against FTC with respect to that non-compete rule.
Yeah, and some people argue that given the fact that non-competes are not enforced in California, that more startups come out of the Bay Area, out of California, other states. So, for example, if you live in Washington State, where Amazon and Microsoft are based, you can't leave Amazon and go to Microsoft without waiting 1 year first. Yeah, so the free flow movement of labor is definitely something that helps California. Okay, great. Well, Ilya, I want to thank you from the bottom of my heart for your time. Please, everybody, check out the Venture Mindset. Thanks again, Ilya. I'm grateful.
Thank you, Chris. Great. Thank you, everybody.
Cool. Thank you. Take care. All right. That was awesome. All right, let me get to your questions here. And again, if you're just joining us, you can go to the two links in the description of this webcast. The first link is Ilya's book on Amazon. And the second link is how you can attend a 2-hour seminar with Ilya for free to learn about venture capital. And I think he also, at the second link in my description of this webcast, he also gives away his 200-page unicorn reports. Okay, great. All right, let me go to the top here. Dewan from South Africa, good to see you. You wrote, I'm exploring various career paths, and I'm intrigued by the idea of advising clients on wealth creation. I want to have the flexibility to recommend diverse investment options ranging from traditional assets like property, stocks, and bonds to newer avenues like cryptos and private equity. Can you please share insights on the professions or roles where I can offer such comprehensive financial advice without getting limited to specific products? Thanks. Yeah. By far the best role I can recommend is private wealth management. And private wealth management, which is kind of like a stockbroker or asset manager for very rich people. But private wealth management is really the only role within all of financial services where you can take your clients with you to another firm. And so a lot of people that work in private wealth management, start at a firm like Goldman Sachs, and they decide for whatever reason to leave to go to Bank of America, Merrill Lynch. So that's what I'd recommend. And if you want to learn more about the skill set to be great at private wealth management, what I recommend doing is take the CFA. That's a Certified Financial Analyst designation. Yeah. All right, Caroline, great to see you. Good morning to you as well. Okay. And somebody just wrote, where are the two links? It's in the description of this video. Yeah, if you can't find it there, let me know. But I did put it there last night. Thank you. Good to see you, Caroline. Okay, and Ildiko from Croatia, great to see you as well. I'm actually going to Serbia for a wedding this September. Luka Anderson, who I co-teach AI courses with, is getting married. I can't wait. Renvir from Mauritius, great to see you. And then Renvir wrote, I'm going to a VC networking event soon. I want to promote my AI firm and also help people. What's Ilya's best advice for networking at such an event? Unfortunately, Ilya just left now. But if you want, what you can do is during our silver office hours today at 10 a.m., just ping me because I'll try to bring Ilya onto that call. Okay. Next up, Caroline wrote, what's the best way to create a stream of income using ETFs? Yeah. So if you don't have time to do research on individual stocks, I recommend investing in ETFs. And the best place to look for ETF research is ETF database. And since you want a stream of income, what I would do is I'd look through for the highest dividend yielding ETFs here. Make sure it's diversified as well. Last comment I'll make on that is don't ever invest in a stock or an ETF if the dividend yield is insanely high. What does that mean? Well, if you see that the dividend yield on a company is 20 or 30%, it means that the market is saying that yield is not sustainable, or it might just be a one-time special dividend. And when you see the dividend yield for an ETF or any stock on a website like Yahoo Finance, you always have to double check to see if it's correct by going to sec.gov and reading the annual report, meaning the 10K for the company you're doing research on. And this is the S1 filing from Meta. Okay. All right. Hey, George, how are you? Rock and roll, you wrote. Okay. Next up, Philman wrote, hey, Chris, hey, are you bullish on entrepreneurship or employment? Yeah. Definitely entrepreneurship. I think when you work at a large company, it can be thought of as an extension to your education. It's not for everybody working in a large company, but if you are a risk taker by your nature, then I would always think about starting your own company. And you have to write a thorough business plan first, because failing to plan is planning to fail. And as Ilya said earlier today, don't be afraid to fail, right? The most successful entrepreneurs have failed more times than you and I have combined. And Michael Jordan, I love this. I got this from Etsy. He said, I failed over and over again in my life, and that's why I succeed. So if you don't mind failure, and if you want to be independent and financially free, so to speak, then look into starting your own company. And the tax incentives for starting your own company are unbelievable as well. Matteo, how are you? Matteo just joined one of my programs. He's based in Italy. Great to see you. All right. Next up, we have Skin Bell, who's Marin Koros, who's also one of my students. And Marin started a company called Skin Bell. I have the product right here. You can go to her website. It's skin-bell.com. And Marin and I are partnering to build our next school. Our first school we built was in Rwanda. The next one is going to be built in her hometown. In Kenya, about a 6-hour drive from the Nairobi airport. And it's going to be in honor of her mother. It'll be called the Ilya Koros Memorial School for Girls. Great to see you. Okay, next up I got Abdulaziz. How are you? Who wrote, thank you, Chris. Hope you're doing well. Likewise. What's your advice to students living in Africa, not connected to advanced markets when it comes to investing? Yeah. So nobody has an advantage over you if they're based in any other country, right? And so what COVID kind of proved to us is that we can all function, learn, and start companies and manage remotely. So all you really need is a computer with high-speed internet if you can get access to it. Yeah. Nobody has an edge over you at all. Send me a message at support@harounventures.com, and I'll help you with more information on that. And I'll give you all my courses and stuff for free, of course. All right. Vishnu, great to see you. Okay, Anurag, how are you? Wrote, hey, Chris, I aim to work as a virtual CFO / management consultant for a small business. What portion of my courses, etc., should you focus on? Yeah, so generally speaking, I would just look at anything focused on entrepreneurship that I teach. Yeah, and starting a consulting business is a lot easier than we think. In fact, in the United States, there's more than 100,000 consulting firms. It's usually just 1 or 2 people. Yeah. And if you're interested in learning more about how to start a consulting firm, please let me know. It's kind of what I do. Yeah. All right, next up, Keith wrote, I'd like to understand your comment on try to fail. Okay, and this is Ilya's comment. I would assume that means something like, even though I think the idea might fail, go for it anyway, or get a prototype out early. Yeah. So what I recommend doing, I always say this, it's my crutch go-to comment with startups, is make sure you write a thorough business plan, okay? So that you assess all of the risks. You don't have to actually have a physical product to launch a company. You know, for example, years ago, I partnered with Kleiner Perkins on a deal in venture capital. And I met a guy there named Randy Komisar. And he had just made $3 billion investing in Nest, which Google acquired. And I asked Randy, and Nest, by the way, is the company that makes those thermostats, the IoT device. I asked Randy, how did you know this is going to be a great investment? I mean, how good was the product? when you met with the management team. And he said, you know what, Chris? They didn't have a product. They had a block of wood that looked like this, but I was really intrigued by how passionate the entrepreneurs were when they were selling. And as Ilya said, in order to be a successful entrepreneur, you have to be incredibly passionate and take risks, of course. All right. All right. Next up, Googly wrote, I want to thank Chris as always. Thank you. You wrote, his work has taken me out from homelessness. Oh, God bless you. God bless you. Wow. Thank you. I'm touched. You wrote a question for the speaker on networking. I'm finding that my personality does not earn me many friends. How do I network? Yeah. I think that the best way to network is definitely using LinkedIn. And tomorrow at 9 a.m. Pacific time, I'm releasing a vlog on how to network using LinkedIn in order to get a job. Check it out. But the bottom line is have an amazing LinkedIn profile. That's step one. Step two, do an advanced search for people that have one or two things in common with you. For example, maybe they went to the same high school as we did, and maybe they're in the same club. Step three, you send an email to this person. Okay, not an email because nobody reads emails. You send an email that says, for example, John, hope all is well. I also went to the Toronto French School, which I did, and I'm also in the X Club. Please let me know if you have time for a coffee or a Zoom meeting. And you might be thinking to yourself, Chris, why would they possibly take a meeting with me? Well, think of it this way. Imagine it's 20 years in the future, and you're 20 times more successful than you are today. And somebody younger than you reaches out to you, reminds you of yourself, and asks for a meeting. Would you take that meeting? Of course you would. The issue is you have to be willing to ask over and over and over again because closed mouths don't get fed. Yeah. And Googly, thank you so much. You touched my heart with that comment. Okay. And Manas, great to see you as well. Okay. And Chibike, thank you for writing drop a like on the video. I appreciate it. Okay. Give me 1 second to get through questions here. Okay. Chibike wrote, if you have to train employees from scratch, how would you ensure that they stay after investing in their training? Yeah. So what Ilya mentioned before was giving out options, right? There's got to be incentive for you to stay. And what a lot of private and public companies do is this. They give you options, meaning shares in the company. And you can't cash in those shares until 4 years from now. And that's called when they vest, when you can cash them in. And so every year you're given more shares every year. So if you want to quit after 1 year, you're giving up, those options, the deferred compensation that you're going to get. And that's referred to as golden handcuffs. And all companies do it. Yeah. Now, if you go to a startup or a company that just went public, and this is my opinion only, but if you're given the option of, they tell you, hey, we'll give you either a higher base salary and hardly any options or vice versa. Always take the higher base. And the reason I say that is because it costs the company nothing to create shares, right? Literally, it's a non-cash expense on their financial statements. And the company's going to give you shares everywhere anyway. Now, don't ever say you don't want any shares. Otherwise, it will kind of signal that you're going to be a flight risk or you're not long-term focused on the company. But always focus on more cash first. Yeah, always. All right. All right, give me 1 second here. Oh, lots of questions. Very cool. Okay, hold on. Okay, and Rajesh wrote, thanks a lot, Professor Chris, for bringing in Professor Ilya. It really helps us get mastermind inputs from the best. Yeah, Ilya is fantastic. He's great. Follow him on LinkedIn as well because he publishes a lot of articles and comments that will really help you take your game to the next level when it comes to starting a company or if you want to work in venture capital. He's great. And I recommend everybody on this call sign up per the links in the description of this video. Sign up to take his VC webinar online for free. Yeah, he's a gem. Yeah. And then Irina from Switzerland, great to see you, wrote, I need this book. Amazing advice. Thank you, Ilya and Chris. Thank you, Ilya. Yeah, and thank you, Irina, for that comment too. Okay. All right. And let me see here. Okay, so I hope you all find the 2 links. Somebody said they couldn't find it. It's in the description of this video. And then weight loss and fitness. Thank you for the $2 donation in Canadian dollars. I appreciate it. I'm Canadian. That warms my heart. That'll go directly to Project Magoo. And for those of you that are new to me, what I want to do is I want to show you what I do and why I teach. So what I do, and my passion, my purpose, my raison d'être, is to use my profits to build schools. And we finished our first school, and that's my son Matthew, in Rwanda with one of my students last year. And that's what it looks like on the inside. And this is my student, Vital. He's wonderful. So thank you so much for that donation. Again, that will go directly to Project Magoo. Thanks. Okay. So you wrote, do you trade futures like ES or NQ with order flows? No. And so last Friday on my YouTube channel, I published a vlog called Why Day Trading Doesn't Work. And I always say this with love in my heart. But day trading, in my humble opinion, is like gambling. And the worst thing that can happen is you go to a casino for the first time and you play roulette and you win. Because the casino will win in the long run. It's the same thing with day trading. The worst thing that can happen for a new day trader is they make money on their first trade. It's not repeatable. And I know it's not repeatable. And I say all this because I really do care. It's not repeatable because we can't name any successful day traders. They don't exist. You have to be long-term focused. Now, if you're seduced into wanting to be a day trader, please understand that each month has 20 weekdays, meaning 20 days that major markets are open. And stocks go up or down in a short amount of time for reasons outside of our control. It could be saber rattling between 2 economic superpowers. It could be economic data points that increases volatility in the market. We can't forecast that. Always think long term. I promise you, and I say with love in my heart, that day trading will not make you money in the long run. Yeah. Okay. And then Photos wrote, thank you for the webinar. It was amazing. And thank you to Ilya. And if you're having issues finding that charitable organization he mentioned for Latin America called La Familia, just send me a message to support@harounventures.com and I'll ask Ilya for the correct link to that organization. Yeah. And Bashir wrote, am I late? No, it's all good. You can always rewind this video. And Urban, great to see you. Vicente, how are you? Oh my gosh, it's been a while. Vicente is one of my former students who got a job at Goldman Sachs in investment banking. Hope all is well. Thank you for hosting this informative interview in office hours. I miss you. I hope you're doing well, buddy. Thank you. Okay. All right. Next up, hello from Bali, Indonesia. Great to see you. I went there on my honeymoon. It's a beautiful place. Okay. Give me 1 second here. And then Manos wrote here, Chris, I actually did some research on your Justin Trudeau story. Justin Trudeau, so he's the Prime Minister of Canada. Here's the Justin Trudeau story I have. Okay, I'll make it really quick. So I'm in 4th year university at McGill back in 1994. And there's this woman who is so gorgeous, a student. So like nobody talked to her. She's like way out of our leagues. And so in the 4th year, there was a charity event in front of the library on campus there, in the McLennan Library. And I said, you know what, man? I'm just gonna talk to her. So I went up to her and I started talking to her. And 5 minutes go by and we're still talking. I was like, oh my God, am I dreaming? 30 minutes go by and she's laughing at my jokes. And you know how awful my jokes are. They're brutal. And by the way, if you ever meet me in real life, I'm a tiny man. But she was laughing at my jokes. And I'm like, Chris, okay, you have to ask for her number. Okay, I'll ask in a second. But we keep talking. And then this dude walks up with like long hair, right? And he looks like Jim Morrison. And he starts talking to her. And all of a sudden, she does this to me. And she's looking at him, the Jim Morrison dude, and laughing at his jokes, which were not as good as mine. My jokes are brutal. I'm like, dude, this is brutal. I just got Heisman, and I don't know what to do. So I looked at him and I said, "Hi, I'm Chris Haroun, and I'm nobody, eh?" And he looks at me and he goes, "Justin Trudeau." And I was like, "Oh my God, I can't compete with a Kennedy." Yeah. Okay. Yeah. And oh God, I shouldn't do this. I'm going to say something political I think is funny. Somebody sent me a funny picture the other day. It was a red hat that's circulating in Canada. And on the red hat, it says, "Make Trudeau a drama teacher again." Okay. So Manas, you wrote Haroun 1, Trudeau 1. No, it's Haroun 0, Trudeau 1. Yeah. Yeah. And then you said, was her name Sophie? No, she was a brunette. It wasn't his first wife. Yeah. He got divorced. Yeah. And for me, MBA does not stand for married but available. All right, next up, Manas wrote, Google and Facebook are paying dividends. And the NYU professor, Damodaran, said they're now a mature company and appealing to more value investors. What are your thoughts on this? Yeah, a great question. Now, probably the best professor when it comes to understanding investment banking and financial statements is Damodaran from NYU. And I used to work at Citadel, big hedge fund, 8 million years ago. And I was in Chicago at the mothership, the headquarters. And I met with Ken Griffin, who's the founder of Citadel. And I talked to him for half an hour. It was an incredible conversation. But I looked at his bookshelf. And whenever I'm in somebody's office, meeting with them that's more successful than me, which is every meeting, I always look at their bookshelf and order those books. And he had a bunch of books from Damodaran from NYU. Yeah, he's great. Yeah. In terms of Facebook being a value investment. Yeah. Yeah. So I don't think Google is there yet. Facebook might be. Now, the issue with investing is you have to classify yourself as either a growth investor or a value investor. There's no in between, right? The market size of growth at a reasonable price investor is very small. So every big company eventually goes from growth to value because of the law of large numbers. They're just big, they can't grow. Like the US economy is a big company. It will never grow more than a couple of % per year. Now, the most dangerous thing you can do as an investor, I think, one of the most dangerous things, is invest in a company that is not classified as growth or value. And I say that because, again, you're either a growth investor or a value investor. And if growth is slowing for a company, the transition usually from growth to value can take a decade. And I call this period in the middle investment purgatory. And it's called investment purgatory because the company is not growing fast enough for growth investors to invest, and it's not cheap enough yet for value investors to invest in. So I'd be really, really careful with that. Now, what can act as a catalyst to move a company from growth to value very quickly is if an activist investor like a Carl Icahn gets involved, right? And what Icahn does is he buys a big stake in a company, he changes it around, and then gets investors to like it more. So let me give you a great example, a case study on this. So for many years, investors were really confused about should I own eBay or not. They were confused because growth investors love the PayPal part of eBay because it was high growth and online payments is the future. And value investors love the sleepy auction business of eBay because it throws off a lot of cash, right? And during recessions, people buy more used stuff. So investors were confused. It's not a growth stock and it's not a value stock. So Carl Icahn stepped in and he took a 30% stake in the company. And he pushed out the management team. John Donahoe, great guy, former bank consultant. I met with him a number of times, really tall dude. So John was no longer there. And what happened was Carl Icahn, because he was on the board of eBay, he had a fiscal responsibility and a fiduciary duty to unlock shareholder value. He forced the company to split into two different companies. One was PayPal and the other was eBay, the marketplace business. And investors loved it. And the value of both those companies went up tremendously because growth investors love PayPal and they invest in it. And value investors love the sleepy auction marketplace business. The slow growth part of eBay. So the bottom line is you're either a growth investor or a value investor. Be very careful about investing in companies that are in transition because it can take a decade. And I learned that from my mentor, Carson Levitt. I worked for him so he was at Citadel, and then he hired me at Pequot, another firm. And it was I think it was like 06 or 07. I wanted to invest in GE, and I gave him my thesis. And he told me, Chris, in my decades of investing, and he used to be George Soros' right-hand man, Carson Levitt. In my decades of investing, I've realized never invest in a company that is in transition from growth to value. Because if it's in transition, the enemy is time. You don't know how long it's going to take to transition from growth to value. It can take forever. Okay. Holy, you're thinking, Chris, I asked you a yes or no question. You gave me an encyclopedia. All right. And then Manas wrote, last week's webcast was fun. Very fun. Thank you. I laughed like crazy at so many instances. Why don't you host your always laugh at me, not with. Why don't you host your 300 webcasts from India, please? It'll be like the October 2024. Oh, then maybe please do it here once. Yeah. I'm actually probably in October, I'm going to be in Portugal, in Lisbon. So I might do my weekly webcast there. But I'd love to do it in India one day. Absolutely. Thank you. Okay, next up, Michael wrote, thanks for the great session today. You're most welcome. After watching your billions analysis video, I was curious if there are tools or platforms to detect when hedge funds manipulate currencies. Yeah. If it's done in size, governments find out about it pretty quickly. And so what governments do is they use AI software from companies like Palantir, which I invested in when I worked in venture capital. I'm not a shareholder anymore, though. And what Palantir does is it looks for patterns in the data. And if governments see certain patterns emerging with all financial asset classes, then they might investigate, right? And the worst thing that you can possibly do is transact on information. And the worst thing about that is if you were to buy options, because options are very illiquid, right? And so if you buy a big option position and the company gets acquired and you buy calls, they're going to investigate you. You might not find out about it right away. Yeah. But software products like Palantir will definitely look for, aberrations in data patterns, et cetera. Yeah. Okay. All right. Next up, Skin Bell, who's Marin, who sells this awesome product here, wrote an amazing session, Chris and Ilya. And then you wrote, how do you think AI will affect healthcare? Okay. What I'll do is I'll ask Ilya about that. Yeah. But I know that Jensen Huang, who's the CEO, founder of NVIDIA, talks a lot about how AI is going to be used for medical research to help us find cures to the biggest diseases. And I believe it as well. I definitely believe that. Yeah, I think that within the next decade, we will find a cure for many different types of cancer. AI is unbelievable. And if you think about, I remember back when I was a kid in the 80s and in the 90s, AIDS was and still is, a material issue. But you don't hear people talking about AIDS as much as they used to. And I think one of the reasons for this is because there's an amazing venture capital-backed biotech company here that's publicly traded called, what's it called again? It's not Genentech. It's another one. It'll come to me in a second. And what they did was they actually found a cure. It's called Gilead, ticker GILD. Yeah. They found kind of a cure to the extent that if you're HIV positive, you take a pill. And the only side effect is you perhaps will die 1 year earlier. So instead of making it to 150, you make it to 149. But I think that there are many other Gileads out there that are going to leverage AI to be able to find cures for most cancers within a decade. Yeah. I'm certainly not an expert in that area. Okay. You guys are laughing at my joke about Trudeau. Yeah. Ramon, I hope you like that comment. All right. Seth wrote, how can I get information on the firms, meaning PE and venture capital? You can always go to their websites. Now, the best way to do research on what the next incredible AI companies are that you should look into using or maybe investing in is this. This is a gem. So what you do is you go to Sequoia's website, okay, sequoiacap.com. And Sequoia is the best venture capital firm in history. And this is me buying time while I'm trying to load Sequoia's webpage here. Here we go. Okay. So Ilya talked a lot about unicorns today. And unicorn means a company with a value of over $1 billion. The top 10 venture capital firms in the world have 1% of their investments in unicorn. Sequoia, 5%. So if you want to learn about AI and what companies to embrace or start working with, click right here on Sequoia's website. Okay, it's called Generative AI's Act 2, and they'll do Act 3 soon. So if you scroll down here, you'll see here a map of the market. Okay, and so if you want to look into embracing certain AI products in different verticals, for example, you can look here. And these aren't all pure plays, but some of them are. So for example, Glean is a really cool product you can download. It's an AI product that is kind of like Google for your entire company, meaning you can search and ask queries on your Dropbox documents, your intranet files, etc. So check this out. Now, if you're a super techie, keep scrolling down. And this is the AI infrastructure stack version 1. I'm sure they'll release version 2 soon. And these are the products you can look at from a developer perspective. Again, that's sequoiacap.com. Okay. Next up, Manas wrote, the United States is going through weird moments. Rates are high, but inflation is also going high. Why is it that Powell is skeptical to drop rates more than once this year? Why is inflation so tricky? So what the government is doing is they're monitoring unemployment very closely. Now, one of the reasons why unemployment is not going up materially is because every single week, 100,000 baby boomers retire. Right, and they're taken out of the workforce. So these are certainly interesting times. Yeah, I think the Fed will likely cut once this year. Yeah, if you asked me 2 months ago, I would have said 2 or 3 times. Yeah, but I think the Fed has done a great job on managing the economy. Yeah, and you have to raise rates when times are good. Otherwise, when times are bad, you can't jumpstart the economy by cutting rates. Yeah. Okay. And I think that AI is incredibly deflationary. I am so bullish on the S&P 500 for the next couple of decades. I think we're going to see an average return of 15 to 20% over the next 10 to 20 years for the S&P 500. Do your own research, but I own ticker VOO, which is an ETF for the S&P 500. The reason I'm incredibly bullish is because I think that many companies are going to embrace AI to materially cut expenses in many different areas. Yeah. The future is now. Sanjay wrote, what are your thoughts on America's debt? Will it go boom in 20 years? And also, what are your thoughts on the war economy? Yeah. So when it comes to America's debt, people always worry about this. You know, every 10 years, I'll see reports where people think the United States is going to go bankrupt. But please keep in mind that everything in this world is relative when it comes to investing. And the very last company, so to speak, that would ever go bankrupt is the U.S. government. And the U.S. government was set up from day one to be a lender, right? And after World War II, American banks did incredibly well, lending to Europe to rebuild Europe. And so the lowest risk investment in the world is United States treasuries. It's all relative. Yeah. And I don't think that the U.S. would ever default in the long run, or I wouldn't worry about the debt issue. Now, the Chinese government is the largest holder, along with the Japanese government, of U.S. treasuries. And if China stopped buying U.S. treasuries, or if they sold tons of them, it would have more of a detrimental impact, in my humble opinion, on China's economy than the U.S. Because China, the U.S. is the biggest export market. And my hope is that globalization continues to the extent that we all have to get along, so to speak. Yeah. In terms of the war economy, your comment there, I don't really have any value to add there, except the fact that it's no coincidence that Ilya today mentioned that a big focus for venture capital firms is defense. Yeah. Okay. Manas wrote, are oil and food that expensive in the United States? Because I hear people complaining a lot since 2003. Yeah, it's inflation, unfortunately. Yeah. But it's different in different regions. So the price of gasoline is much higher here, and it's much higher in Hawaii, but it's much cheaper in Kentucky, for example. It's all based on how close you live to where the natty gas plants are. Yeah. Vicente, God bless you. Thank you for that donation. That'll go directly to Project Magoo. And Project Magoo is a charity that is not registered in my name. It's registered in Vital's name. Thank you. Okay. And Manas wrote, we love your explanation like Wikipedia answers. Yeah, no, thank you. By the way, if anybody here is in school and your professors tell you don't use Wikipedia for research, well, the simple solution is this. Use Wikipedia for research, but look at the sources and go directly to those sources. Yeah. Okay, and then next up, Marin wrote, hey, Chris, can you please be able to review a company/investor that's based from developing countries so that those of us from there can see ourselves in this? Just a thought. Yeah, I'd love to. Yeah. And if you want, what you can do is later on today, I know we have office hours for the program you're a part of. You can ask me there and I'll do a real-time analysis over Zoom. Next question is from Manas, who wrote, what is the magic of Silicon Valley? Why is there so much successful founders there? So there's a couple of reasons. We're seeing a lot of protests on universities right now, campuses. We saw a lot of protests in the 1960s, maybe even more so, probably more than what we're seeing right now. And what happened in the late 1960s was at Stanford University. It's interesting. There was a lot of riots on campus, peaceful riots, and the same thing at Berkeley. Because at Stanford, at that point in time, there was something called Stanford Research Institute, and 50% of Stanford's R&D budget back then was classified government military weapons research, and so students rebelled, rightly so. And so what happened was Stanford Research Institute was pushed off-site, off campus, and it's now called SRI. It got rebranded. And at that point, what happened was a cultural shift to the extent that it was part of the hippie movement where, the administration thought, hey, let's be open-minded. Everybody's ideas are accepted, like Ilya mentioned earlier today. And there was a hippie movement, the peace-loving movement, etc. And that spread throughout all of California, especially to Berkeley. And at that exact same time, what happened was just around 1960, Americans were brokenhearted because their biggest competitor at that point in time, the Russians, beat America to space with Sputnik, right? And so consumer confidence got hit hard in America. Americans were depressed. So the Kennedy administration in the 1960s created NASA. And Kennedy was an incredible president. He also created the Peace Corps. So Kennedy created NASA. And NASA's goal was to put the first person on the moon before Russia does. But in order to do that, you needed technology. In fact, you needed to have 100,000 transistors in the fuselage, meaning top part of a rocket. And so what happened was the first notable venture capital investment was done out here in the Bay Area in the company that made those chips or transistors. And that was called Fairchild Semiconductor here in the Bay Area. And so in 1969, America put the first person on the moon, and everybody was happy. And Fairchild Semiconductor grew a lot here in the Bay Area. And that coincided with the whole peace movement and open source, meaning sharing of information movement as well. I explained a second ago. Now, what happened was with Fairchild Semiconductor, it grew and got really bureaucratic. And so people left Fairchild. And we call those, the chip companies that came out of Fairchild, Fair Children. Companies like Intel, this is Intel processor, AMD, NVIDIA, etc. And they started their own companies here in the Bay Area. And then around the semiconductor industry, the hardware industry started to emerge. Okay, companies like Apple, etc. Then the software industry, right? Microsoft was founded in '76, but there's a lot more software companies here in the Bay Area than in Seattle. Then the internet industry. And the internet was created by ARPANET, which is a government agency in the 1960s. And the internet was created because of the Cold War, because there was fear from the US government that, God forbid, there's nuclear war. How would the East Coast of America talk to the West Coast? And so the internet was created out of government research, so that there's a web of communications between East Coast and West Coast, for example. And then there's a lot more military weapons research that actually led to innovation that we all use today. So, for example, GPS is actually guided missile research, right? That came out of Silicon Valley and Israel as well. Also, Oracle, big database company. Larry Ellison's first contract was with the CIA called Project Oracle, right? And that was the CIA's first secret database. So all those events occurred at the same time, meaning the peace hippie movement here in the Bay Area, as well as the space race. And that created this culture here on the West Coast of startups. And one more important thing that happened in the Bay Area, the legal system on the West Coast here is a little bit different. So we talked about when Ilya was being interviewed about non-compete contracts. So California is the only state where non-compete contracts are not upheld. And what that means is this. If I work for Cisco, for example, and I want to quit and go across the street and work for Juniper, even if Cisco has a non-compete agreement with me, it's not enforced. So I can go to Juniper tomorrow. Then I can come back to Cisco the day after, hypothetically speaking, if I want to. You don't have this in other states, just in California. Yeah. Okay. All right. And I do have to wrap up this call in a minute or so. Okay. Next question is, Marin wrote, Chris, how would somebody from Africa be able to invest in, say, the S&P 500 or Vanguard? Yeah. So regardless of what country we're in, what I recommend that we do is get a list of the 5 biggest banks in your country and call each one of those banks and ask them, if possible, please transfer me to your brokerage department, right? If they have a brokerage department. Then talk to the brokerage department and ask them. Now, you might not be able to buy the same ETFs that Americans do, but I'm sure there's other ETFs you can invest in. Just make sure that the fee structure is quite low, meaning you pay well under 50 basis points or 0.5% annual management fee, and make sure it's liquid as well. Yeah. Yeah. And then once you talk to the brokerage department of all five firms, you go with the one with the lowest fees, of course. Yeah. Okay. All right. All right. Next up, weight loss and fitness wrote, since day trading does not work, what is the best way to get into financial markets as small investment fund? Focus on long short portfolio or just invest long term? Yeah. So I would say if we don't have time to do research on companies, just buy ETFs, right, from reputable firms like Vanguard. But if you do have time, what I would do is I would pick your favorite investment theme and then start doing bottoms up research. So let me show you what that means. So from an idea generation perspective, we can always go to etfdb.com, etfdatabase.com. And we can scroll down here and pick a theme that you're interested in. Let's say that you're interested in lithium, for example. Okay, so what you can do is you can look at ETF firms or ETF funds for lithium, like my favorite one, which is LIT, because it has a cool ticker right here, LIT. Then what you do is, okay, say you're bullish on lithium as a theme. Then you can look through the biggest positions in this ETF and start doing bottoms up research on these individual companies. And when you look to invest in companies, look at fundamentals first, valuation second, and a distant third, technical analysis. Okay. And I don't want you to have more than 5% of your portfolio in any one particular stock. So that means you have to have at least 20 stocks in your portfolio. And that's good risk management. Now, if you invest in cryptocurrencies, and I've been saying this for years, I think that 95% of all cryptos are scams. If you invest in cryptocurrencies, I don't want more than 5% of your portfolio to be in cryptos, and I don't want any one crypto to be more than 0.5% of your liquid net worth, meaning in your portfolio. Yeah. All right, cool. And then Keith wrote, I love your chat GPT and AI from finance. Love the course. Thank you. I finished the qualitative analysis on Palantir. Okay, cool. Starting the quantitative analysis. What is your take on Palantir? Yeah. So I did a ton of research on Palantir. I invested in it when I worked in venture capital. I'm no longer a shareholder. Ilya talked about being intellectually honest and trying to see the negatives of investments as well. So rather than telling you the positives, I'll tell you the negatives. One of the biggest issues with Palantir is it's not a traditional software company where you just sell the software and you're done. It's much more services oriented, right? To the extent that if you buy Palantir's products, one of them is called Gotham, and then Metropolis is the other one. It's cool names. But if you buy those products, there's a lot of work that needs to be done by employees of the firms buying the products because they have to feed in the data all the time into it. So it's not as high margin a product as you think. Now, on the positive side, whenever I look at an investment, I always ask myself this. In 5 years, will this sector it's in be more relevant or less relevant than it is today? I would say a heck of a lot more relevant. And by looking at it that way, you don't get seduced into value traps, meaning buying stocks that are cheap for a reason. Yeah. Okay. Next question is, I can take a couple more and then I got to wrap it up. Manas wrote, why are IPO prices too high? And sometimes companies like Beyond Meat and Reddit may never cross their prices. Why is that? Yeah. So what typically happens is when a company goes public, the investment bankers underprice it by like 30% or so. And that's logical because if you sell something at the value it's supposed to be at, it's not going to go up. What's the incentive to buy in the IPO? So they discount it by usually 30% or so. So it gets that one-day pop. Now, if the company's fundamentals improve over time, then of course you'll be way above deal price in the long run. With respect to the companies you mentioned there, Beyond Meat and Reddit, it all comes down to execution. Yeah. But you got to think long term. Like Warren Buffett was saying that if you invested in Coca-Cola in the IPO many, many years ago, you'd be down 50% 1 year later. But if you held on for the long run, obviously you would have made a fortune. And so, as Mr. Buffett says, the longer the view, the wiser the intention. Okay. And then Nico wrote, thank you. Learned a lot again. Thank you for being here. I appreciate it. And then lastly, Manas wrote, thank you for everything, my mentor. God bless your family and you all forever and ever. See you next week. And forever, I have a bigger nose than you. Not true. Not true. Look, okay. I go through. So this is the makeup powder I put on so I'm not shiny, okay? This is a new one, okay? This is what it looks like brand new. Maybe I'm beautiful. Maybe it's Maybelline. This is what it looks like after one application. See, it's almost out. And the reason is because this is, oh my God, it is so big, this nose. But it is aerodynamic. Like I can usually win when I'm ski racing and stuff when I tuck because it's aerodynamic, yeah. And lastly, I got to say, and this is cray, but I had more women looking at me, checking me out during COVID than ever before. And the reason is because I wore one of these things, okay? So when women would look at me, and this never comes off, they might think, oh my God, Chris, you might be attractive. But the second this comes off, they're like, oh my God, that's brutal, put it back on. Okay, so I know there's more questions. I'm gonna wrap this up. God bless you. Thank you so much, Ilya, for joining this weekly webcast. Again, you can go to the description field of this webcast and access 2 links. One link is Ilya's book, The Venture Mindset. And the second link is how to join a 2-hour webinar for free that Ilya hosts on venture capital. And you can ask him questions that way on the webinar as well, if you have follow-up questions. And also at that link, you can get access to his 200-page unicorn research document. Thank you, everybody. God bless you. Have a great weekend. Great to see you, Keith, Vicente, and everybody. And thank you.